Good morning, everyone, and welcome to our three-part webinar series for restaurant recovery. This is hosted by SCORE Monmouth. We are a business mentoring service based in New Jersey. We offer free business mentoring to the local business communities. Today's webinar is geared towards restaurant recovery and the impact that COVID has had on restaurants in these times. So we have a number of presenters today. It's not just myself and our actual guest presenter. We have a number of guests today. We have Chris Carlsson, who is a longtime SCORE mentor and volunteer. He is very much in tune with the financing that is available for all businesses, but today it's to do with restaurants. We have Babette Gallagher, who is from RBAC, and that's a certified development company. Any of you who I get my introductions incorrect, you can correct them when you take the floor. We have Richard Santore, who is from Bielat Santore, Mike Carafa from Manasquan Bank, the Vice President of Commercial Lending, and Andy Glatz from Peapack-Gladstone Bank. I think I got everybody. So I'm going to hand this over. Oh, just a couple of small housekeeping things. We will be taking Q&A throughout the presentation and throughout the discussion. So if you could place your questions in the Q&A function box on Zoom and not in the chat box, we'll do our best to get to all the questions. This is being recorded, so it'll be available on our YouTube channel after the webinar today. And I think that's it. Chris, I'm going to hand over to you.
All right. And good morning, everybody. I'm going to see here if I can start sharing my screen with you. I think that is it. There we go. And yes, good morning. Welcome to SCORE's and Bielat Santore's restaurant financing series. I'm Chris Carlsson. I am a retired CEO and entrepreneur of 25 years. Nowadays, I do kind of what I like to do, and I help small and mid-sized companies, typically that are in some kind of financial trouble. And then I also do a lot of volunteer work for SCORE. And today, Monmouth SCORE together with Richard Santore at Bielat Santore is doing this three-part restaurant hospitality financing series. I am excited to have Richard with us. He's a 30-year veteran in the restaurant hospitality industry financing area with a lot of experience, knows a lot. And for those of you who will attend all three, it is actually a certificate program, so you will get a little certificate at the end. I am more of a generalist numbers guy and finance type person. Richard is expert in the restaurant financing industry, so we'll be relying on him a lot. We also have great leaders in the industry, like Claire said before, Michael Carafa with Manasquan Bank, Andrew Glatz and Babette Gallagher, Andrew with Peapack-Gladstone and Babette with RBAC and CDC. So let's kind of jump in. Today, it's more of an overview. We're looking at different options of financing you may have at the restaurant or hospitality owner. We're going to do more of a deep dive into these in a subsequent seminar. Today is more of an overview and kind of give you a Reader's Digest and a breakdown a little bit of what these different programs mean. So with that, let's just kind of jump in. Keep in mind also, when you listen to everything like this about financing and lenders, banks, and sometimes it's hard to remember, but banks, lenders are actually in the business of wanting to make loans. That's their business. That's how they make money. They're not here to try to turn you down. They're actually to try to give you a loan. So anytime you work with a bank, have that in mind. They actually want to help you. And Richard, you're the resident guru in this area. So anytime you want to jump in, just jump in. Feel absolutely free.
Okay, thank you, Chris.
So we're going to start with the commercial loans, and they're also usually referred to as term loans or mortgages used for business purposes and typically with properties. There are liens associated with this, also sometimes called UCCs, which means that there is a security by the bank attached to your property. And typically, what you end up doing is to have a separate entity buying a property and have an operating entity operating a business in that property. That's kind of the basis for it. And Michael, you're probably going to jump in and going to ask you a little bit more about that particular, why you do this and what's the benefits of it.
Sure. So if you're going to be buying a property, typically there's two reasons you do it. Number one, for tax purposes, and number two, for liability purposes. When you create a real estate holding company, you insulate your assets, your business, your operating business assets from any liability that may come from somebody who falls on your property and sues the real estate holding company. So that would be one reason why you would want to separate the two entities, have an entity that owns the real estate and an entity that's going to operate the business separately. In terms of filing a mortgage, when you buy a piece of property, the bank is going to file a mortgage against that piece of property. That's recorded at the state and the county levels, so that anytime anybody goes and runs searches, they're going to see that Manasquan Bank has a mortgage against the property. We finance the acquisition. Along with that, typically is an assignment of rents and leases. So you may decide that you no longer want to operate your business out of the property, but you're going to hold the real estate for income purposes. So what will happen is the bank files this assignment of rents and leases, which says that in the event that you decide to default and not pay the bank anymore, the bank can then go to your tenant and ask the tenant to pay you directly. Additionally, if you're going to be in an owner-occupied space, the bank will typically ask the operating business to guarantee the loan, which means in a default scenario, they're going to approach the operating company to help repay the loan. And in a situation like that, the bank will file UCCs, which basically attaches any equipment that the business has or owns that is not financed elsewhere. The bank then does have the ability to take that back as collateral and use that to repay the loan as well.
Right. And also what it practically means is that if you go after a loan like this happens, if you go and try to do another financing for that entity that owns the real estate or in the real estate, any lender will actually be able to see that there is security on that property already.
That is correct.
And here also we see the current practicable rates, and I think this might actually be a little bit outdated, but we have seen lately that the rates are starting to inch up a little bit. And also typically when you see this kind of commercial loans, you see two different timelines. One is the term, which means that that's the time over which the loan is actually going to be outstanding. And if it's a 5-year term, that means that in 5 years, this loan is going to be repaid as a balloon or refinanced by the lender or another lender or the same lender. Then you have the other portion. Usually a lot of owners get confused with these two, and that's the time over which the loan is calculated to be paid back. And that is the payout or the amortization time. So you can have a 5-year term on the loan, but you can have a 25-year calculation of the loan. So it's divided up to 12 months in 25 years. LTV is an important term, loan to value. That tells the bank how much of the appraised value of the property that the bank is willing to lend on. The DSCR, the debt service coverage ratio, is also one that typically the owner doesn't really understand what it means. And in a very abbreviated description of that, it's really says how much profit over the loan that the entity that has this loan has to have. So if you pay $100,000 a year in loan payments, if it's 1.2, you have to have $120,000 worth of a measure of profit. And we'll go into that in subsequent seminars, but that's basically what it means. Maybe Michael, you want to jump in a little bit more here to give some more color. When you look at an applicant for commercial loans, going to buy a building, for example, or maybe refinance a building that they're in, what's the first thing you look at for that applicant?
The first thing that we're going to look at for the applicant is we're going to look at the business, assuming it's owner occupied. We're going to look at the strength of the business, because the reality is that business is paying the debt on that property. So we want to see historically, what type of revenues you've generated, how your expenses trend over usually a 3 to 4 year period, sometimes 5. And then we want to see what your net cash flow is. In situations, with smaller businesses, most banks will require personal guarantees. What that means is that they're gonna take the individual who owns that business and owns that property, and they're gonna sign a guarantee, and we're gonna then use their income as an asset to help repay the loan. So when you look at everything, you're going to look at everything as a whole. So you're going to say, well, the owner may take all of the profits out of the business, but when you add the owner back into the cash flow perspective, now you're looking at what we call a global cash flow. So you're taking into account not just what the business generates, but also the income that owner is taking out of the business and using that to pay back the loan as well. Just to kind of touch base on a couple of things you said, Chris, in regards to terms and amortizations. Typically, commercial mortgages are 20 to 25 years, owner occupied, loan to values up to 80%. So what that means, just to make it a little simpler, if you want an $80,000 loan and you get an 80% loan to value, your property has to be worth $100,000. A balloon. So a typical mortgage would have a 20 or 25 year amortization. So your payment is based on, if it's 25 years, 300 payments. Now, in some banks do balloons after 5 years. So what that means is you're going to make 60 payments. After that 60th payment, that whole balance that's unpaid is going to be due in full. Some banks, like my bank in particular, Manasquan, what we do is a rate reset. So we'll fix your rate for 5 years, and then at day one of the 6th year, that rate will reset to a spread over an index. Now, that's typical mortgage. On equipment financing, if we're talking about a term loan per se, you're going to have a fixed period depending on the depreciable life of that asset that you're purchasing, 5, 7, maybe 10 years, depending on what you're buying. And typically those are fixed terms, and where there's no balloon, there's no rate reset. It's a straight payout. So if it's a 5-year loan, the loan is paid off in full after 60 payments.
And Michael, we have a question for you here. That is, what do banks look for when a new restaurant is looking for a loan, i.e. one without an operating history? They're going to start a new restaurant.
So the 3 things that we're going to look for first are the owner's experience. That's going to be the key, because if you're looking to start a new venture, what is going to give the bank some security? What is going to help us get comfortable with a new restaurant, a new loan request? So the first thing is going to be the experience in the industry. How long have you been in the industry? What aspects have you managed in a restaurant? Were you the restaurant general manager? Were you a cook? Were you a bartender? Those kinds of things. That's the first thing. The second thing is what kind of liquid injection you're going to put into it. So if you're going into a space,
how much money they're going to put in, right?
Yes, how much money they have to put down on the acquisition, on the new project. And the third thing would be, are the projections and the business plan you put together is that something that we can wrap our heads around, that we can understand and know, do those numbers make sense? And that's the biggest thing with, that's probably when it comes down to it, is the biggest thing is what the projections look like. Is it pie in the sky? Are these really not attainable numbers? Are your table terms way too high for for the space you're projecting and the market you're in? Does your menu, which would be a projection number and a business plan number, does that make sense for the market you're going into? So those are the three key things that we as a bank would look at for a new restaurant.
Okay, great. And on that last note there, Richard, in a separate webinar, is going to be deep diving into the projections and how you get to the requisition for a loan.
Chris,
How long does it typically for commercial loan, not involving SBA or any other entity? What's the time frame from typically from the start, when you start the process with a bank till you close? How long time does it take?
Just Rich, you started to chime in there. Did you want to have a
I just wanted to add to what Chris was saying regarding the towards the end of this webinar tonight. Well, this morning, we're going to go over the ingredients that Michael's talking about and putting a loan requisition package together. We're just going to outline the components. We have two follow-up webinars. The next one will be actually assembling the loan requisition package. And the third one, as Chris said, will be how to put all the pro forma statements that Michael's talking about that the bank is going to be looking for to see if this is a viable loan. So we're going to get to that toward the end of this and an outline form and in two successive webinars.
Right.
Sure. And then Chris, I'm sorry, what was your question one more time?
Typically, I'm not asking for specific, just general statement as to typically in the normal, typical average case, how long does it take from somebody says, I'm going to go and get the loan, they contact you, and typically how long is the process till you actually end up closing?
So for an existing business where we have historical financials, you probably 30 to 45 days for an approval, and anywhere from 45 to 60, maybe to 75 days to actually get to the closing table.
You're talking 2 to 3 months.
2 to 3 months typically. And you know, during that time frame, the bank is completing its underwriting. We're getting our approvals, we're running our searches, judgment searches, lien searches, that all factor into getting to the closing table. If it's a new business, those are digested a little bit slower. We're going to analyze those a little bit deeper, especially being a new entity. So those are probably going to take 45 to 60 days for an approval, and probably overall 60 to 90 days. So about 3 months to get to the closing table.
Richard, on that note, what do you typically see in kind of a very general, short, quick answer? What can borrowers do, potential borrowers do, to speed up those timelines?
Is that a question for me, Chris?
Yeah, yes.
The real thing that borrowers can do to speed up is to assemble the information that's going to be required. When we go through this loan requisition package, you'll see that we like to submit a complete package with everything in it and give it to the banker, so that the banker doesn't call and said, you forgot this, can you get this? And that just delays and delays. If you give it to the banker all in one shot, we found in our experience that we'll get a yes or no within 14 days. Either yes, we want to do this loan, or no, this is not a loan for our bank. And that helps, because if it's not a loan for the first bank we go to, we in a short time frame we know we gotta look for another financing source.
And to piggyback off that, typically when I'm looking at a loan request, I'll send typically an email and I'll have bullet points. I need X, A, B, C, X, Y, and Z. The quicker you are to respond with all that information, and all that information in one shot, gives me an ability. There's always going to be follow-up questions when you're underwriting, but at least if I have the information ahead of me, we're not having the back and forth where I'm asking you for additional information.
Okay. Let's jump over to the line of credits. Line of credit is very short described as that's a loan where you have a maximum amount, and at any given time you can draw from zero to that amount and help finance your business with that. And typically the size in that depends on what the lender, what the bank think you can muster, what they can risk that you actually take out. And for smaller companies, typically, that line of credit is secured by business assets. So, Michael, in this, what are good candidates for line of credits?
Those people who have the first thing that people tend to confuse with a line of credit is a line of credit really is not used to buy hard assets. Okay, it's really not used to buy equipment for the business that you're going to operate, and it's typically not that way because a standard line of credit may have a 12-month term, and it's going to be at a higher interest rate than typically what your equipment financing would be. So that's the first thing to understand. What a line of credit really should be used for is to support your payroll, to support your inventory purchases. So if you're a restaurant, you need to buy fish for the day, you'll use the line of credit, and then as you sell that fish, you pay back the line of credit. So it's a shorter term. It's typically a floating higher rate product. So when we say we're going to finance the business, you want to finance your day-to-day operations, not your hard assets, not your equipment. So that's the first thing. The second thing that we're going to look at is we're going to look to see typically how you handle your receivables and your payables. If you have payables, and they're stretched out, why are they stretched out? Is it because you really need a line of credit? You need to help turn those a little bit faster. Lines of credit typically are better suited for existing operating businesses, to help them with their existing business. Now, if you're talking about a startup business, that's kind of a different, that's a little bit of a different animal right there, and how you look at that. Normally, there's a degree of permanent capital financing that's built in at the onset of a new entity, a new business, to help them do that initial stock up for their inventory for whatever it is that they sell.
We have a question here from the audience, and that is that the restaurant owner here has had a long experience, and typically he sees that most loans that he has been able to do has been SBA related. How many loans does your bank do in the restaurant hospitality industry not backed by SBA? How common is that?
That's a little bit of a loaded question.
Yes.
But I would say that we do acquisitions primarily with the help of the SBA, and typically Babette and myself work very closely together. And actually, the three of Babette and Richard, we've all worked together on multiple occasions. So probably 60 to 70% of what we do is in the SBA world. If you have a long-term operator who has strength behind them, who has equity in the business, that's somebody that we could do on a conventional basis without the SBA involved.
So it's really the very strong credit risks, the very strong companies end up doing without the SBA. The rest is really with SBA.
Yeah, that yes.
Okay. We're going to jump to the next one. This was Michael Carafa, Vice President of Commercial Lending with Manasquan Bank. Thank you very much, Michael.
Thank you.
Don't jump off, please.
I'm not going anywhere.
So here, we're going to now jump into Andy's area and talk a little bit about SBA Express and SBA 7A loans. To me personally, and I think that is for a lot of people, the whole SBA is kind of a little bit bewildering. At the same time, yes, I have had an SBA loan myself a long time ago, and I have a lot of friends who in the last couple of years have been very successful being able to get SBA loans, either directly through bank or through CDCs. And what quickly, Richard, your overall view here, how do you see it? Do you see this market heating up? You're seeing that something going to happen here after we get out of the pandemic?
Well, the one thing I see, and then I'll turn it over to Andy because he knows this more in depth than I do. But the one thing that I see is that the SBA, the government, is now making a big push to try to help small businesses. There are some very good programs out there right now, especially in this second round of the stimulus, to help restaurants, mostly in the acquisition phase. It's really not that much in the refinancing, although it can be done under some SBA programs that we'll talk about. But mostly for acquisitions, the government's offering favorable terms, willing to waive fees, and to help small businesses get back on their feet after a year of shutdown here. And I think if the government has done something good, the SBA has stepped up in this time frame.
Andy, you can add your color here. I do have a question. This express loan and the 7A loans, who are these specifically for? What do you see? Who gets these type of loans?
Well, let's see. I'd say qualified small businesses, but that's another loaded question there. I would,
Yeah,
if I could just take a
none
second.
of us who are not in the lending business understand what that means.
No, if I could just back up to Rich's point there with the SBA and to what you said earlier with the banks wanting to lend money, the SBA wants to lend money as well. And, especially in this challenging environment that we're in and we've been in for the last year, the SBA's rolled out a couple, really good incentive programs to promote the bank to lend and also to try to, help out the small businesses. So a little more detail on that. From now until September 30th, the SBA is waiving the guarantee fee. And that's the fees that are associated with closing the loan. They'll range anywhere on the 7A program from 2 to 3% of the loan. So that's a big savings to the borrower. And that's not added to the loan. That's not paid back later. That's right in their closing documents, the fee is waived. And they're also going to make the first 3 payments, principal and interest payments on the loan. It's capped at $9,000, but still, that's a pretty good incentive. Is it going to work for everybody? Maybe not, but it does. The way the SBA is looking at it, and also the bank, is to say, all right, those 3 months of payments. Hopefully, as things continue to improve, vaccines are rolled out, and the economy continues to improve a little bit. Maybe those 3 months will carry them through that transition period, or get us into the summer when things start to really improve. It's a big difference. So.
Andy, I have seen some dates out there with, is there an expiration to these programs?
September 30th. That's the fiscal year end for the SBA. That's what they're putting this as a stop date. They may extend it, but right now, that's the date they're looking at. So from now until September 30th was when these programs are available. And that's nationwide. Any of the SBA lenders can handle this for you. So it's a nationwide program with the 7A, and it's a good program. I think we've been using it a lot. It's a benefit to the bank. We get an increased guarantee from the SBA, and it's also a cost saving benefit to the borrower, because just to take a second there, you mentioned with the SBA and why use it. It's still difficult, and it's hard to candy coat it, but with the everything going on in restaurants and hospitality and hotel, they've been struggling. It's a tough industry. Banks want to lend new money to customers, help out our existing customers. All banks are the same. We want to try to help the people. Very challenging when we see financials and the marketplace and where things are. The SBA, sometimes they help us overcome that hurdle. They provide that guarantee. They provide us the ability to maybe expand our credit box a little bit more.
Yeah.
What's that, Chris?
I not in the restaurant industry, but a couple of times here for a couple of companies I've been helping turning around. 2020 has been a completely different year, and we've been successful in saying that forget 2020, let's go back to 2019. We were successful. 2021 will return to 2019 soon. Do you see something like that too in the restaurant sector, that banks and SB are willing to look at the world that way?
No, absolutely. And I think that's the only way you can look at it. Little more challenging to do that without some, without the assistance of the SBA or EDA or some other program out there, because, banks are still required to, have our regulators out there and do full underwriting. So that's why I think the SBA is such a great program where we can look at projections and pro formas and take that into consideration. That, last year it was what it was, but we have the prior years, we have some good pro formas, the assumptions to support it. Mike made a great point, and that's always up there. The management experience, have they done this before? How did they handle some other downturns in the market? What was their capacity at the place that they're running now? Do they have the experience? Because, we're bankers, we're not restaurant owners. So we rely on their expertise in the industry to get them through it. So if to get that across to the people on the call, I'd make sure that your lender understands that. And, it sounds silly. We always ask for resumes and backgrounds. That's important. I'd put as much information as you can down there to say that, give your lender comfort that you can run this business, that these projections aren't just pie in the sky, that you can support them. You've done it before, or, and I know it's very, again, challenging times, but the more support and comfort that you can give your lender, I think that's key.
Yeah, Andy, a lot of my clients, when they're first-time acquisitions and I direct them to the SBA loans, they said, look, I don't want to be bothered with the SBA. It's months and months of paperwork, and it takes 6 months to get a loan. And they don't realize that their loans are really coming from the banks being guaranteed by the SBA. Can you talk a little bit about the benefit and the advantages of working with preferred SBA lenders such as your bank, Peapack-Gladstone?
Right. So that, Rich, good point. So as a preferred lender, what the SBA does is they delegate the authority to certain banks or lenders. And the reason is the SBA doesn't have the resources. So they dedicate that authority to certain banks out there to streamline the program. So as a preferred lender, we don't have to have it underwritten again by the SBA. And what that means is that that's a time delay. So usually, Mike was right, it takes 45, 60 days to get a loan done. If we have to go back to the SBA, or a bank has to go back to the SBA, it could be double that. And that's where you hear some of these stories. It takes, 3, 4, 5 months there. That's tough. That's a long time, where normally it should take that 45 to 60 days to get it done. And a preferred lender is, it's a big benefit to the borrower.
And another question from the audience here, and that might be both you and Babette, and that is that there is a new CARES Act going on, and there is a rumor that there is some more incentives coming in that on the lending side. Do you know anything about that?
The one I mentioned earlier is part of it. That was with the waiving of the guarantee, the increased guarantee to the bank, a couple months of payments to new loans, 3 months of principal and interest payments. There's always talk out there that, there's going to be another, I don't know if this would be PPP3 or another CARES Act. I haven't seen it.
Okay.
The challenge with that, though, Chris, is, if you wait by the sideline, sometimes it doesn't come, or it doesn't receive the approval. And then the one that is out there now is exhausted, and, it's not available anymore.
Yeah.
So it's hard to say.
From the sound of it, everything going on, if you can muster it, if you have some resources right now, and your 19 was good, this might be one of the best time to actually get a loan, and the easiest time that you've seen in a long time.
I agree with that. I agree with that, because especially, I'm talking from the SBA world here with the increased guarantees and, the incentives out there. It's it could be a good time. I hesitate a little bit, to, your business, be realist, make sure that the projections make sense. I would always, Mike, Babette, we do the same thing. We sensitize them when we look at them anyway to say, all right, that's maybe a little bit of a pie in the sky. We'll ratchet it down. But be a realist with the projections, because that's what we're going to do. We're going to look at it and say, all right, if 19 was this, I don't think you're going to double business. I think it may improve, but I don't think it's going to be doubling. So, just be a realist, do the best you can. But now I think could be a good opportunity for people to get back on their feet.
And if I could just speak that pro forma or projections, what we've been doing with the banks during this COVID is we've been putting in the pro formas at 100% occupancy, but we've also put an additional pro forma in at a 50% occupancy to show the bank that even at 50%, there's still at 1.2 to 1 debt coverage ratio available to pay the loan. I mean, the owner may not make any money. He may pay himself and pay his loan, but the loan is able to be serviced. And I think that's key for a bank to look at that in this environment right now.
Rich, you're right on. Right. We're going to look at the break even. What do they need to make? What occupancy? We never talked about this before, but if just suppose there's some more restrictions in place or they don't release them as quick as we think, can it support the debt based on 75, 50, 35%? Where does it fall off? And that's just, you're right. We're going to look at that. Very important.
Okay. So let's jump on and we come back to, I'm sure that questions are going to come in. We're going to roll back to everybody. And thank you, Andy. And please stay on. I'm sure there are going to be questions for you.
Thank you.
Appreciate it. And now let's jump into SBA community advantage and dig a little bit deeper into that part of SBA. We have Babette Gallagher from CDC with us here. Maybe, Babette, if you could start with explaining what a CDC is. Should they contact you directly? Can they go through a bank? How does all that work?
Right. So thank you, Chris. So RBAC, as Chris mentioned, is a certified development company, otherwise known as a CDC. We can work directly with clients on requests such as a community advantage loan. Those generally will come to us maybe through a bank for a client. Maybe the loan request just doesn't fit the bank's criteria, or it might be on the smaller side of a loan amount, and they may reach out to us to provide that financing for clients. So, but essentially a community advantage loan, it's basically a 7A loan, similar to what Andy would provide. In terms of, the use of those funds, it can be for any business purpose. It can be to acquire assets. It can be, used for, just permanent working capital needs. But the maximum loan amount on the community advantage loan is $250,000. So the SBA sort of created this community advantage loan program to serve those clients that maybe the credit needs are just less than the banks are, have the capacity to handle the volume. So for loan amounts up to $250,000, the SBA provides a guarantee of 85% for loans up to $150,000 and 75% of loans between $150,000 and $250,000. The maximum that we can do is dependent on the collateral that is pledged for the loan. And again, we're going to look, at personal credit scores, repayment ability, use of the funds, various things go into the underwriting decision on these loans. The rates will generally float between prime +3 or prime +4. And they can be used, like I said, for any business purpose. So that is, just sort of in a nutshell what the Community Advantage Loan Program is. And again, borrowers can come directly to a CDC for those loans. Very often the referral will come to us through a bank, whereby maybe the applicant just doesn't meet the bank's lending criteria.
Okay, so you pick up a little bit where the bank can't do it by themselves. So then you have some more ability to serve a community that can't do it directly through the bank.
Right. So our credit underwriting, although it's still stringent, might be a little bit less stringent than the banks would be. So, we encourage people maybe that are either starting a business or are just new, not all that established yet. Community Advantage can kind of fill that need where the banks are just not ready to lend to that company yet. So this program was kind of designed to fill that need in the market.
Talk a little bit about SBA 504 loans. Most people who are not in the lending industry, like me, more don't really understand the difference between like a 7A and a 504, and what they're
Right.
how it works, the guarantees, and who puts in what money, all that stuff.
Right. So the SBA 504 loan program is very specific in its purpose, and that is to provide long-term fixed rate financing, typically for, it's really designed for owner-occupied real estate and equipment purchases or refinancing. So when you think 504, think about it as an option to finance fixed assets. Cannot be used for working capital, cannot be used, to purchase a liquor license, but it can be used to purchase, say, a restaurant building, or the equipment that would go into the restaurant. So it's definitely a fixed asset type loan program, and it's very specific in its purpose. The design of the 504 program, we're always going to be participating with a bank. When you do a 504 loan, you're always going to have a bank that provides the 50% first mortgage lien position loan. The SBA is going to participate with the bank using a 504 loan, which is a second lien position loan on the property. So the 504 loan is always going to act as a credit enhancement to the bank, because the bank is always going to be in first lien position on the property. And the SBA 504 loan is going to provide up to 40% of the project cost in a second lien position.
So in this
the benefits
actually
to
put money into the project.
I'm sorry, Chris.
In this, so in 504 loan, SBA actually puts money in. They actually fund.
Right. So, and this is important to understand, the funding of the 504 loans is created once a month. The SBA sells a government guaranteed bond. They sell a 20-year bond and they sell a 25-year bond. The proceeds of that bond debenture are used to fund all the 504 loans in the country. So the borrower ends up with a first mortgage loan to the bank and a completely separate loan to the SBA 504. So it's unlike the 7A loan program where the bank provides all of the financing and the SBA gives the bank a guarantee on that note. With a 504 loan, the bank's first mortgage is a conventional first mortgage, but it's capped at 50% typically of the project.
Okay.
So the SBA 504 loan is funded directly by the SBA, the bond, and it's always in a second lien position.
Okay.
Let me just real quickly, the benefits of the program to the borrower. Like I said, it can actually provide up to 90% financing. So where the banks might stop at, depending on the project, they might cap their loan to values at 70, 75, 80%. When you use the 504 loan, that loan to value can go up to 90%. So it's less of a cash injection from the borrower when you use the 504 loan. And the other major advantage to the program is because these loans are funded with the 20 or 25-year bonds, the rate on the 504 loan will never change for the 20 or 25-year term. Those rates right now are right around 3%. And once the 504 loan funds, it's a fully amortizing 20 or 25-year loan with a fixed interest rate attached to it. So, that's another huge benefit to the program, where when Mike spoke about rate adjustments on the bank's loans, normally the banks will adjust their rate every 5 years. But with a 504 loan, the rate does remain fixed for the 20 or 25-year life of the loan. That's the big advantage. And a lot of times the banks will use the 504 loan program, to mitigate their risk. It's definitely a credit enhancement for the bank. And the bank can, sometimes just do a little bit more for that client outside of that project if they use a 504 loan to help support the financing.
Okay, great. Thanks, Babette. Appreciate it.
One thing I was surprised to learn, and there are only 3 CDCs, community development corporations in New Jersey, which you are one of them.
Right. So, yep. So RBAC happens to be the largest of the certified development companies in New Jersey. We can administer the Community Advantage Loan Program and the 504 Loan Program throughout the entire state of New Jersey, Eastern Pennsylvania, and Southern New York State. So, and it's only through a CDC that you can get a 504 loan. We sort of act as a conduit to the program, and we're licensed by the SBA to administer those loan programs.
One other question, but with the new stimulus program, is there a new wrinkle in the 504 loans being able to refinance what they couldn't before?
Right. So we talked about 504 loans being used to finance the purchase of real estate and equipment. It can also be used to refinance real estate and equipment. And we can also provide some cash out based on the appraised value of the property when we do a refinance. There are some changes that are coming to the SBA 504 refinance program, whereby we should be able to refinance 7A loans that were used to purchase the commercial real estate for a client. That program is yet to be rolled out, so we expect that later on this year that we'll have that revised refinance program that will allow us to refinance existing government guaranteed debt, which we're not able to do right now.
What would that mean? That means that somebody who needs working capital, they can refinance and get some money out of the property? And
right. So right now, Chris, we are able to refinance, and we've done some of these projects actually with Manasquan Bank, where the client may have equity in the real estate. So we're able to go in, refinance the first mortgage loan, and also carve out an additional piece for eligible business expenses based on the appraised value. So it has been really useful for some clients, especially over the past year, where they can pull some money out of their real estate and use it to help support their business. So that's a very nice feature with the refinance program.
great, thank you. I think that we'll cover the other programs later. And Richard, why don't you jump in and start talking a little bit, kind of a little primer about the business plans and the loan requisitions.
Chris, can I just make one comment? I just want to piggyback off Babette. When Babette had said that debentures are funded once a month. So just so everybody's on the same page, when you're doing a 504 with a bank, the bank is going to approve you for 2 loans. They're going to approve you for that first mortgage, that 50% loan. That second loan that the SBA is going to take out, the bank is going to have to do a bridge loan.
Right.
So when you go to a bank and you approach a bank for a 504 program, the bank is actually going to underwrite you for 2 loans. The SBA is going to approve you for that bridge loan. That bridge loan is what's going to get taken out and converted to a 20 or 25-year permanent facility with the SBA.
Okay. All right, Richard, you want to jump in?
Yes, I'd like to thank Babette and Michael and Andy for joining on. I've been working with them for years. Chris made me a little younger in his introduction. He said, I've been doing this for 30 years. Actually, this is my 39th year in this business, and we've been financing or helping our clients finance for 39 years. And, you know, with all of these, all of our panelists said is very true. You know, there are things that we need to know when we go into a deal, and they already spoke to those. The loan to value, it's very important to know, you know, how much you're able to borrow, what makes sense for a bank. You know, we put that in perspective right up front when we work with our clients. The debt coverage ratio, to make sure that the business can pay the debt, is secondarily important. The third one, which wasn't mentioned yet, but the credit worthiness of the applicant is key. If you don't have good credit, it's going to be very tough to place a loan. And the fourth one is your experience, which Michael and Andy both talked about. And your experience is really unfolded by the lender or the investor by them going through and reading your loan requisition package, right? That's how they get to know you. That's how they get to absorb, you know, what your goals, what your project is all about. That's how they learn about your business. That's how they see how much you know about your business, how your financials projections look. And these are the key elements. You know, we talked about the different kind of financing that are out there, the commercial loans, the 7(a) loans, the 504 loans, even the crowdfunding. All of those, you need a presentation, you need a package to get that loan. And without that presentation, without a complete presentation, your chances are not as good as getting the loan. Even if you have a terrific business, if you can't spell that out to a banker or to an investor, you know, they might pass on your loan. So this particular part of this webinar is, I think, the most important. And for 39 years, we've been doing it. And to show you how far we go back, we really got our first training on putting a loan package together from Alan Turteltaub. I don't know if you remember Alan. He started something called the Money Store. You remember the Money Store years ago was a very big SBA lender. And he told us right from the beginning, look, if you're not going to give me all the information up front, I'm not even going to look at this, because it's just going to be, you know, going back and forth and piecemeal, and it's not going to work. So over the years, I'm not going to say we perfected a loan requisition package, because it can never be perfected, but we've refined it, and we keep refining it, and we keep adding to it. And we're going to go over the components in an outline form today. And as Chris said, in subsequent webinars, we'll drill down into exactly what they look like and how to put the performance together. But the first thing you need to sit down and do is put a business plan together, you know, a roadmap, right? What are you looking to do? Why are you seeking this financing? What is your concept all about, right? How do you plan to work through the next 5, 10 years or whatever the loan you're requesting, and make sure that loan gets paid consistently in a timely manner? A lot of that is your own words. You write it, you sit down, you edit it, and you perfect it, right? But you want to also show visuals to a banker. You want to show, you know, your design concept, your photos or the renderings of your place, what it looks like. You know, like a picture speaks 1,000 words. And if you're doing a new outdoor bar and deck, or if you're putting a new room on your restaurant, or if you're renovating your entire kitchen, you know, showing a lender or an investor what that looks like really helps him or her get a better idea of what you're looking to do. Right? A sample menu should be included, and that may be one of the most important types of your brand. You know, your sample menu should include prices, and those prices are the basis of your detailed cost analysis when you put your pro forma together. This gives lenders, right, a clear understanding of your price points, right? It's the first building block to figure out your check averages. It's, like I said, it's a basis of your financial projections, and it's an added assurance to the lender that you've done your homework. The next part of that presentation is your management team, right? Who is running this place? I'll tell you one thing right now, an investor or a banker does not like to see, and you'll probably get a no very quickly, is absentee management. If you think that you're going to own a restaurant and not work there and get a loan, your chances are slim and none, right? The banker or the investor is going to want to see a hands-on operator, right? So you need to put an overview of yourself, your resume, what you've done this far, how established you've become, demonstrating your work experience and how you acquired all this experience to run a successful restaurant. Even if you've never owned a restaurant before, like Mike said, if you've been a manager or a bar manager or a chef, but you know the industry and you're looking for your first crack at owning your own place, that is very important, right? Your experience level. And also your team. If you are a restaurant owner, who is your chef? Who is your general manager? Who is going to run your wait staff? All this should be laid out in a full deck as part of your requisition package. It's always important to talk a little bit about your service, right? Your service is how your restaurant will operate. Are you going to do takeout? Are you going to do curbside? These are big now, outdoor seating. Before the COVID, restaurants really passed on those. They say, come on in my restaurant, sit at my bar, sit at my table. But now they've seen that there are other profit centers, right? Curbside and takeout helped a lot of restaurants get through this COVID to this part. Outdoor has become big. They see in the fair weather months, and we only have a few of them here in the Northeast, but there is money to be made outside. So you want to illustrate that to the lender. What kind of marketing and publicity are you going to do, right? The restaurant landscape is very competitive, right? You have one just about on every corner, right? Or if you drive down a highway, you got one at every 3 or 4 properties. So discuss your pre and post-opening marketing plan. Show the lenders and investors how you plan to gain traction and how you want to keep that momentum going once you get that traction. Talk about your target market. Who's going to eat at your restaurant? Who are going to be your customers? How old are they? How young are they? What's their average income? Where are they coming from? Are they walking to your restaurant? Are they driving? If they're driving, do you have parking for them? All of these things are important to include in your package. And the market, the target market also includes your location. Talk about the city, the area, the demographics of where you are. Give them a little overview of the area. You might even want to show the competition in the area and to show the lenders, these are my main competitors, and this is why I think our concept and our operation, will be able to chip away at some of their business because we're doing things they're not, or we can do things better than they're doing. Another key ingredient, and I can't express this more importantly, who are the specialists and the consultants that you're working with? You need to have a good attorney, right? Especially if you're going to deal with banks and bank financing and SBA financing. Believe me, there is a mountain of paperwork that needs to be processed on any one of these loans. You don't have the time to do it, nor do you have the expertise. I don't have the time to do it. You need an attorney that has an office that's done these, right? That could go through this paperwork, that can do the searches, that could expedite the closing documents for the banks. If you don't have an attorney that's familiar with real estate transactions, and in most cases liquor licenses as well, what you're doing is you're paying for his education, and you could be jeopardizing his loan. So the attorney and the accountant that you choose or work with are very important in getting your financing. The accountant is going to have ready for you all the necessary tax returns and financial statements, profit and loss balance sheets that the bank is going to request from you at the time, right? If you're redoing your restaurant or renovating or gutting and opening up a new one, who's your architect? Who's your designer? Who's your contractor? Right? All of these things should be, a paragraph about each, and maybe some photos about the work they have done within there. Very important for a bank to know that you're surrounded by good professionals. The business structure we touched about a little bit before. I'm not going to go into that, but you should let the bank know if you're incorporated, if you're a partnership, if you're a limited liability company. Those are things that will have to be spelled out. And usually, as Chris pointed out in the beginning, you're going to have an entity that buys the real estate. You're going to have an entity that owns the liquor license and operates the business. There's going to be a lease between the two, from the operating to the real estate company. And the bank is going to want to see that lease is at least the rent payments in that lease, or at least the amount to cover the mortgage and the taxes, etc. All right. And the very last part of this package is the pro forma statements. And you heard all the bankers, talk about it. It's what they look at in the approval process, right? And there are really two core reasons they look at it. One is to ensure that you can make the debt service based on the cash flow that's available. But the second one's even more important, to ensure that you understand your business and your industry. As Andy said, if you give a bank some pie in the sky projections, they're going to look at them, with a blank stare. All right, they've seen enough of these that they know, what a restaurant or a bar or a catering facility, can generate, and what their average gross profit is, and what their expenses should be, to know that if they're way out of line, they're going to put that loan to the side and really not give it a hard look. So the pro forma statements that are typically provided are several. A projection of the income and expense for the first year. And as I said before, now in this COVID environment, it's not only based on 100% indoor occupancy, it needs to be based on maybe 50% occupancy. We're at 35% right now. 50% occupancy is a reasonable number, because there are other elements that we spoke about, the curbside, the takeout, the outdoor, that even if we still are at 35, you would average out 50% or better. A 12-month operating forecast, break that year down into months and show what the cash flow is for each and every month. A 5 or 10-year projection of your income expense. A break-even analysis. That break-even analysis shows an investor or a bank exactly the amount of gross sales you need to do based on your cost of goods and your expenses to show that you can pay the debt. You got zero left over, but everything's paid. Your expenses, your cost of goods, and the mortgage or the debt service. A source and use of funds. You're requesting a certain amount of money from the bank. What are you going to do with that money, right? Where are you going to use it? How is it going to be utilized, right? That's an important. If you're going to do construction, you're going to need a breakdown of an estimate of what your improvements are going to be. Another one that's not listed here is a add back analysis. If we're restaurants or in the hospitality industry and you're tuned into this, you know that every single nickel isn't really displayed on a formal document, if I can just say that correctly. But you can show a bank based on your tax return using an add back analysis that there's plenty cash available to pay the debt, right? And that's a that's an important part of your presentation. The bank's always going to look for the collateral, right? They're going to want a mortgage on your first mortgage on your real estate. In the case of the 504, they're going to want a first and second mortgage. They're going to want a first pledge security interest in all the furniture, fixtures, and equipment. They're going to want a pledge of the stock or the membership units in the entity that holds the liquor license. They're always going to want a personal guarantee from the borrower. And if your collateral is not sufficient in your asset itself, they may look for outside collateral, such as a residence or another property that's owned. You're going to get tied up pretty good on a loan. The bank's going to make sure that they're going to get paid one way or the other, and you got to know that going into it. If you're going to go into a loan and say, look, I'm not going to sign personally, then I'm going to tell you you're not going to get the loan. So personally, they're going to want to see your resume. They're going to want to see your credit. You're going to look at your personal financial statement and at least 3 years personal tax returns. If you own other businesses and you're working with the SBA, you're also going to have to present corporate returns on those other businesses that you own, right? So it's an in-depth package. I mean, it's soup to nuts from the business plan all the way through a hefty set of financials. Everything has to be put together in a neat and tidy binder. And in the old days, we used to bind them up physically and deliver them to the bank. But now with Dropbox, and banks have their own system, we deliver them electronically to them, and it saves a lot of time. And with all the bankers that we're working with, Manasquan, Peapack-Gladstone, and Babette and RBAC, they're extremely efficient. They are extremely responsive. They're probably some of the best in the business from my experience. And they're going to give you a fair shake. They're going to give you a fair shake. They want to do the loan, like Chris says. That's how they make their money. But they want the information precise, compiled accurately, and presented at one time.
Yeah, Richard,
leave it off.
Thank to that is that for many business owners, this seems like an overwhelming process. But I would also say, if you use somebody like Richard, who has done it many times, Richard knows exactly where you should go to get this information that you need, so that you can get as fast as you can. They would know where in your financials to get the information, where to look, tell you how to get it fast. You can't do this alone. You're going to need help. And the other comment to that is that this is not just for the bank. Typically, when you do this, this is a roadmap for how you see yourself doing a successful business. That's one of the keys that you have. When I do turnarounds, this is one of the things you do. First things you do, this is how we're going to do it. And then you got to stick to it as much as you can, of course. Okay, we're running a little bit over, and maybe we should kick it back here to Claire to do the wrap up. And I personally thank everybody. I think it was a great webinar, and I'm looking forward to see you at the different aspects of this in the future. And thanks, everybody. Oops, sorry.
Thank you.
Thank you so much, Chris. Maybe you could just stop sharing your screen.
I will do that. Yes, I can't multitask, talk, and do that.
So thank you everybody for joining. I hope you found it valuable and insightful, and thank you so much to all the presenters here. It was great. We have our next webinar on this series on March 25th. It's Thursday, March 25th at the same time. If anybody had problems logging in, or if anybody knows of people who may have had problems logging in, I know there was a little bit of confusion with how our system works and how it sends out the invites. So please let everybody know that this is available on our YouTube channel, Monmouth Score, and we'll send out, and what I'll do after this is send a link to the recording when it's posted to everybody who had registered, just so that they can see it. again, thank you very, very much. And Rick, yes, the replay will be available on our YouTube channel. I just saw you posted that question. So yes, it will. And we'll also probably try and put it onto our Facebook page as well, share the link to the YouTube channel on our Facebook page. Again, just about SCORE, we are a free mentoring service and we offer free webinars to the local business communities. We are a nationwide entity sponsored and powered by the SBA and SBA funding, but we are all run by volunteers in each of our chapters. So if anybody you know is looking for a mentor or looking for webinars, please check out our website at monmouth.score.org or our Facebook page, because that's where you'll find all the information. Again, thank you so much to the presenters. We really appreciate your time. It's very, very valuable information, especially for the struggling restaurant industry at the moment. So we appreciate your support. And with that, I will sign off and say thank you for attending, and we will see you on the next webinar.
Thanks, everybody. Have a good day.
Thank you.
Thank you.
Thanks, everybody.
Thank you all.
Thank you. Thank you.